Hello, and welcome to the first session on order to cash recovery, what it's worth. This session will cover what are the sources of errors in Amazon's remittance processes, be it invoicing, supply chain, or marketing service errors, and what you can typically expect to recover if you are running an automated order to cash recovery process. Or putting it slightly different, what's at stake if you are not? Order to cash encompasses the whole process from purchase order placement through to cash collection. That is from managing the orders and payments from Amazon, which can be done through manual efforts or EDI connections, all the way to reconciling the payments in order to close the books. Central to this process are Amazon's vendor remittance reports, which detail all payment decisions based on invoices, goods received, and any charges or withholdings applied by Amazon. Implicit within these reports are erroneous charges and claims stemming from discrepancies between the information Amazon has versus what your ERP system knows to be true. Unless you actively find and dispute the discrepancies, you won't recover any erroneous deductions. Regardless of whether you dispute erroneous deductions, the accounts receivable function incurs significant personnel costs, from claim adjustments and invoice reconciliation to managing and classifying accounts payable charges for Amazon services. You may also need IT support to resolve settlement upload issues or reset credit limits if your ERP system halts further Amazon orders due to unpaid invoices. These are real costs, both direct and indirect, that can be reduced by optimizing your order-to-cash process. The erroneous charges stem from Amazon's deduct and pay system, in which Amazon nets off any amount projected to be owed by the vendor to Amazon before they remit payment for goods supplied by the vendor. Since Amazon never wants to try to collect money off a vendor, Amazon deducts invoice adjustment claims and service charges like advertising or cooperative marketing that you have agreed to. The vast majority of charges made by Amazon are correct. However, mistakes do happen because humans are involved with the receival and counting of goods to the manual setup of many contracts, or because the charging basis is wrong due to some catalog misclassification. Unfortunately, unless resolved automatically by Amazon before the payment due date, it takes a vendor dispute or case to recover missing payments or erroneous charges made by Amazon. Our data suggests that about 10 to 15% of invoices for small to medium vendors go wrong in some way and require extra effort to resolve. This additional effort manifests itself in unnecessary labor costs, payment delays, and reduced revenues, few of which are visible to the important stakeholders. Contesting charges manually and keeping the financials straight is a lot of effort for most vendors and requires painstaking records. Depending on your marginal labor rates and system or service costs, it may not be economical to chase every shortage. However, if your marginal cost to identify and dispute becomes trivial, the game changes and your recovery potential gets close to 100%. Unfortunately, you won't get close to addressing all erroneous charges if you have a manual process, because the effort to dispute small amounts does not make sense when using Amazon's dispute process. So what about EDI? Although EDI provides standard messages for managing orders, shipments, and invoicing, both in ideal scenarios and when errors occur, Amazon's remittance statements are not included in their EDI implementation. To fully audit bank payments, you need not only the remittance statements but also the data transmitted via EDI and additional reports that aren't available through EDI. While using your ERP's automated closing features would be convenient, the system lacks the complete information needed to fully automate 15% of invoice closures, thus complicating your month-end close. While this session is focused on what it's worth, in the next section, why is this hard? We'll delve deeper into why Amazon's EDI implementation falls short. So, what's it worth to your company? After serving thousands of vendors of various sizes, we are going to summarize the opportunities based on invoice claims errors and then supply chain penalties or marketing services errors. We also break out the difference between mid-size and large vendor accounts, those in the $100 million per year range to those in the billion-dollar-plus range. Shortage claims typically run from 3 to 20% of vendor revenues. The median value for smaller vendors is about 6% of invoice, and about 4% for large companies with well-proven integrated shipping and invoicing systems. Shortage claims arise because Amazon's receiving process has recorded a different receipt quantity than invoiced. Shortages will be raised a few days before the invoice due date with the suffix SC appended to the vendor's invoice number. If Amazon subsequently finds the goods, you'll find a shortage claim reversal denoted with an SCR suffix on your remittance report. One important thing to know is that the recovery success rate on shortage claims is very dependent on the point in the process where Amazon takes responsibility for the goods. Shortage claims have a higher recovery rate when vendors have chosen collect or prepaid freight, whereby Amazon signs and takes responsibility for the goods upon collection from your dock. If Amazon or their carrier subsequently loses them, then you can argue it is not the vendor's fault. Hence, recovery rates are very dependent on freight terms used and can be as high as 100% if you are on collect and prepared to chase every penny. Here you can see chasing the shortages for a business that does $100 million in revenue on Amazon can recover $6 million by disputing shortage claims. Price claims are similarly easy to identify and sometimes reach 7 to 10%, but more typically are less than 1% of invoice value. There is surprising complexity to price claims and the research involved. Price claims arise when Amazon finds that the unit pricing on the invoice differs to that on the purchase order. Ideally, any erroneous PO unit pricing would be noticed before PO acceptance to be closely followed by a subsequent dispute of any chargeback for a declined PO. To win a price claim, you need to make the case that the PO did not adhere to the published item cost unit pricing, or that any deal or special pricing used was not applicable. To avoid price claims arising in the first place, vendors need to get ahead with planning product catalog phase-in and phase-out, which is a major cause of mismatched ASINs, along with product price changes, such that Amazon gets the expected product at the expected price. If you make a special deal that affects unit pricing, you need to be sure that you can execute against the resulting agreed bulk deal POs. Otherwise, Amazon will try to use deal pricing on subsequent replenishment POs. Companies with more mature catalog systems and stable pricing tend to do much better than companies with more volatile catalogs, manual maintenance, and late edits. Recovery rates for price claims are erratic because the party at fault is less clear-cut, given catalog and price volatility, coupled with propagation delays in Amazon systems. With Amazon's leverage over vendors, and with vendors responsible for most information updates, you can expect better than 30 to max 50% recovery rates. While it is a smaller recovered amount than what we saw in shortage claims, our example company that has $100 million in revenue did recover almost $300,000 in price claim disputes. An often overlooked opportunity is uninvoiced purchase orders. These are typically the result of errors in human handoff or perhaps EDI invoicing failures that go unnoticed. These are easy enough to find because Amazon highlights them in the Amazon Vendor Central UI. What's needed is the discipline to regularly work through all the accounts that the vendor has, perhaps across multiple marketplaces, and to get the invoicing restarted. If there is any evidence of systemic failure, then this should be fixed at the source to stop such issues from recurring. We regularly find such opportunities and estimate them to be worth up to 0.5% of annual revenue. The recovery rate is very high, and you can look back several years. So depending on how much vendor business you do on Amazon, medium to large companies can recover $6.6 million to $44 million just by auditing and disputing Amazon invoice claims. Continuing with supply chain and marketing services errors, chargebacks are supply chain fines for non-compliance to Amazon's order placement and goods receiving procedures. New vendors learning the Amazon process suffer the most until they get their processes in order. Companies with a multi-year experience of Amazon should have few excuses for chargeback rates over 0.25% of revenue. Recovery rates vary dramatically by chargeback type. Chargebacks triggering extra handling or prep by Amazon are hard to successfully dispute unless you have contemporaneous evidence like photos of overpacking or compliant wrapping. Chargebacks related to unfair expectations, like declining a PO with unreasonable pricing or surprising volume, should have better recovery. Recovery rates are very dependent on the mix of chargeback types, but are generally low, and hence most effort should be invested to avoid such chargebacks in the future by fixing the root cause of the problem at source. Here you can see that trying to recover chargeback revenue retroactively would only net 0.25 to 0.3%, whereas fixing the causes in the first place will avoid the charge. Note, chargebacks must be disputed within 30 days of the claim. For just about every company, co-ops are the largest source of Amazon charges. Co-ops are a vendor-funded subsidy for the tasks and costs borne by Amazon getting the product to market. Co-ops can have various charging bases against products in the agreed scope and time period, including net receipts or net sales in a calendar month, or one-off straight payments. Of particular interest is net receipts. Amazon charges against expected net receipt volumes, so if actual receipts are lower than expected, for example, as a result of a shortage, then Amazon will have overcharged for a co-op. Getting to these quantity differences is tedious because the shortage reports are not fully maintained, the volume of transactions is large, the amounts involved are small, but the recovery rates are good. That said, this is worth up to 6% of revenue, but likely more like 0.2%. Another source of overbilling by Amazon concerns overlapping contracts stemming from assorted scope or catalog setup errors. Contracts can overlap in several ways. Contracts might overlap in a time sense whereby two contracts of the same type are effective at the same time. For example, we found the same ASINs on the same purchase order getting charged with two damage allowance agreements, one of which was provisional, but had evidently not been turned off. Other examples of errors we found are multiple GLs charging specific ASINs, miscategorized ASINs attracting the wrong GL rates, and charges from contracts outside their expiry period, although by default the rates will continue until the contract is superseded. We've also seen freight allowances charged when the vendor was directly paying for freight themselves. Such errors occur sporadically but are worth checking when agreements are phased out and in. Recovery rates against such errors are good, but they are challenging to find manually and do not occur very often. Note, Amazon's co-op terms and conditions typically auto-renew unless you, the vendor, give prior notice before the next year. So it's good to review all of last year's co-ops prior to your annual negotiations and cancel all of those requiring revisions or those no longer profitable. We've covered a lot in this section, but the big takeaway is that managing this process effectively can recover a significant percentage of revenue. Our example, our businesses would recover $7.2 million and $48 million per year. Thank you for watching our first session on the business case behind having an order-to-cash application to help your business. Up next, in Session 2, we described why this can be a daunting task for your company's financial operations personnel, and why order-to-cash consultancies, or outsourced services, typically only recover a portion of what's available and have to charge higher recovery fees. If you would like to get started with a free review to understand your own opportunity, please contact us and get yourself on the path to better margins with some early cash wins up front.